Hi, and welcome to Best in Tesla. So there is a lot of noise right now about Tesla because Elon is buying Twitter and is talking about a new litigation department. Elon is talking politics. All that changes nothing fundamental about Tesla as a company or the outlook of Tesla and the potential growth. All just noise. But the stock price has been down from its all-time high to almost half the price. But now it's a little bit up again. But I would like to try to explain why I only see this as a discount to buy more stocks on the way back up. Why Tesla stock is bound to go up much higher, even just viewed as a car company. And why some stock analysts get this so wrong, or why they at least think that Tesla stock is so overvalued. But what most stock analysts are usually not very good at is predicting disruptors and exponential growth companies, because it does not fit into their spreadsheet that has been made to analyze other car companies. And this is what Tesla is. A disruptor, and is growing faster than anyone before them and is speeding up. And that is why most Wall Street analysts don't get Tesla. It's a growth stock, and the stock market is all about growth, right? So I would like to try to show why I think Tesla's valuation is going to be much higher than it is today, or even their all-time high, simply on the car sales. So we are going to talk a little bit about EPS and PE ratio, competition and comparing to other OEMs, demand, production, stock price and short sellers arguments. So strap in, because we're going on one heck of a ride. So let's dive right in. So there are two stock market tools that are very common: EPS and PE ratio. However, they're not always reliable when we look at them alone. EPS is earnings per share, and that's pretty simple. You take the company's net income and divide it by the numbers of outstanding shares to get the EPS, earnings per share. PE stands for price to earnings. To find it, you take the company's share price and divide it by the EPS you just found. So two very simple measurements to assess a company's value. But I personally think the PE ratio is an oversimplistic number that has fooled many investors before into thinking they know what a stock is worth. But you need a much bigger picture than just one or two numbers. And you can only compare apples to apples with the PE ratio, not a retail store against a software company and so on. So these numbers are all very relative. And what is not very good at is measuring a disruptive company with huge growth potential. And the problem with Tesla is that many automotive analysts only compare it to other car companies, and therefore Tesla's PE is way too high. But Tesla is not just a car company, so this is a very flawed way of doing it. But as I will show later, it doesn't really matter. Just as a car company, Tesla will go up. But disruptive companies usually don't fit into analysts' small boxes and spreadsheets. A very good example of this is Amazon. People laughed as much at Jeff Bezos and Amazon as they did of Elon and Tesla. But we all know what they say about the ones who laugh last.
You generally hear him before you see him. It's the ear-piercing laugh of billionaire Jeff Bezos. And Wall Street isn't concerned that Amazon has never made a profit, not a dime. In fact, it lost $125 million last year. The company says it's investing for the future. Skeptics say it would have to sell every book being sold in the world today to justify its stock price.
I think my generation grew up with Sears.
And Amazon is worth 20% more than Sears is worth in market capitalization.
How do you view that phenomenon that Amazon today is worth more than Sears?
Investors are focused on the future. Amazon has growth potential that Sears doesn't.
A couple of geeks who sketched out some software could destroy Sears Roebuck.
That's the beauty of technology and the microprocessor. We've never seen anything like it.
Yes, they did beat Sears, who was once the largest retailer in the United States but filed for bankruptcy in 2018. Sears has a long history dating back to 1886 when it was founded by Richard Sears. And as you can hear in the video, the journalist can hardly say the words "Amazon is trading for more than Sears" without laughing. He thinks this is insane because Amazon did not fit into the box of a normal retail store. So EPS and PE ratio just didn't work here. Also because they were still unprofitable and no one believed the growth the company would go through or the decline that Sears would go through. And Jeff Bezos is now the world's, well, second richest man.
Jeff who?
And Sears is no more. I guess Jeff Bezos got the last laugh. So, does this sound familiar with Tesla versus the legacy automakers? Very much so, but I'll get back to why Tesla is so much more than a car company. But let's pull all that aside right now and just look at Tesla as a car company, as we could have had a look at Amazon just as a retailer, because they did actually beat Sears as a retailer in the end, just online instead of a physical store. It's all about growth. So let's compare Tesla to the self-proclaimed leader in the EV race, GM, because I don't think we will find a much better comparison to Sears than GM, the biggest boy in the US car market that has been around for 100 years, and automotive analysts are laughing just at the thought of Tesla being valued multiples higher than GM. So let's try to take a look at the fundamentals of the company. So they almost have the same earnings now. As we saw in Q1, Tesla had $3.3 billion in net income and GM had $3.1 billion. Tesla even beat Ford, Toyota and GM in Q1, even though GM sells about 6 times more units. So Tesla's growth in earnings is very impressive. And we know the stock market is all about growth. So this is also one thing that has made automotive analysts so wrong about Tesla, because they didn't believe Tesla could make this amount of money on selling cars, because no one else has ever made this amount of money on mass-produced cars. But Tesla is fully integrated, so they don't have to pay the markup to the supplier for the part, because Tesla make the part. They get to keep everything for themselves. Like everyone else buys seat from a third-party supplier, but Tesla make their own seat, and it's the same seat that goes into all the cars all the way from the Model 3 to the Model X. This fact alone saves a crazy amount of money the good old automotive analyst did not account for, and therefore got it even more wrong. So that is why Tesla's earnings per share is a little bit better than GM's, because Tesla has a bit more in net income, but Tesla has about 1 billion outstanding shares and GM has about 1.4 billion outstanding shares. So GM shares is a bit more diluted, so Tesla is doing better than GM when we are talking about earnings per share, even if we look at them trailing 12 months. But what most analysts don't get is Tesla's crazy high PE ratio, because this is where GM and Tesla are in two very different places. Trailing 12 months, Tesla has PE of 90 and GM about 6. So some would say, therefore, you should not buy Tesla stock because the PE of 90 is way too high and it's about to go down. Maybe, but the stock price can still go up even though the PE ratio goes down. I will show that in a bit, but others might say, well, it is this high because people are willing to trade the stock at 90 times its earning because the potential growth that is coming in earnings. So just because the PE is very high is not equal to the stock is too high. And this is also why we can't just look at PE ratio alone. But I'll get back to that later. Let's look at some other fundamentals about the company, because it's all about growth and the company's economy. So GM and Tesla actually have almost the same amount of cash on hand. GM have 21 billion and Tesla has 18 billion. So again, very positive for Tesla, a small, nimble company with $18 billion in cash on hand. But 21 billion for GM is not that much, because when we look at the debt, well, Tesla almost have nothing. They have like $7 billion in debt, and GM has over $110 billion in debt. So Tesla could pay off all their debt if they wanted to and still have $11 billion in the bank. If GM used all their money in the bank to pay off their debt, it would still have $90 billion in debt. GM basically has no money, only debt, and has to spend billions of dollars to the switch to EVs, while Tesla is only making EVs. Tesla is not in competition with its own ICE sales as GM is, and GM has to wind down their ICE business, and that will be very painful and very expensive. But the stock is all about growth, right? So let's compare the company's growth so far. So let's look at the big one. Earnings. How are they doing today? Well, in Q1, GM was down 2.7% in quarterly earnings. What about Tesla? Well, Tesla is up 657% in quarterly earnings. Now that is what I call growth. And that is why Tesla is now beating GM in net income here in Q1. So Tesla is again showing the best sign here and the growth that we're after. But what about units sold? GM sells more units. Yes, but earn less money on it, so that's not really good for GM. But what does the trend show us about the company's units growth? Well, GM's unit sales have dropped 37% since 2016. They have not had 1 year where they have been able to stop that trend, and they fell faster in 2018 and 19 than they did in 2020 and 2021. So the excuse about the chip shortage and the COVID doesn't really hold up. They are only new excuses. So GM is down 37% over the last 6 years. And Tesla? Well, Tesla grew 1,133% in units sold since 2016. Again, it's all about growth, right? Tesla is growing, GM is shrinking. And Tesla is growing faster even though they're getting bigger, and that is a rare thing. Q1 2020 compared to Q1 2021, Tesla grew with 96,000 units. But even though they grew this much, they grew with even more the next year. From Q1 2021 to Q1 2022, they grew with 126,000 units. And to put that into perspective of the other EV makers, because GM has pretty done nothing, they sold less than 500 EVs in Q1, so they are simply just not in the game yet. But Volkswagen, the legacy automakers that are pushing the hardest, only sold 99,000 units in total in Q1 for the entire Volkswagen group, and Tesla grew with 126,000 units. So as you can see, Tesla is growing faster and faster, and the others are not even close to catch up. They are actually getting further behind. But they sell millions of cars. Yes, ICE cars. That is the past. That is not an asset for the future. When we look at stocks, we're trying to look to the future, right? And there will not be any ICE cars in the future. It is difficult to even wind them down, and the old guys will lose a lot of money getting rid of their ICE business. It is not an asset. It is a problem. So look into the future product. That's the EV. Well, GM made 480 units in Q1. So everything is pretty much going down about GM. They still have next to nothing in production of the only thing that will bring in value to a car company when we are looking to the future, the EV. And that is what stocks is all about, the future and the growth. But what about demand? Well, let's make a quick point here about the demand. All the EVs the short sellers have been talking about are out, and Tesla is only growing faster. That should tell you something. And when we are comparing to GM, well, GM Silverado is the most pre-ordered car GM has ever had in its 100-year history. All of this just to say everyone, not just Tesla, but everyone, will sell every EV they make until the market is saturated. So until then, Tesla will sell every EV they will be able to produce, just like everyone else. So the only question we need to answer is how many cars they can produce. And Tesla is aiming for 20 million cars in 2030. So now it becomes a question, do we believe Tesla can do it or not? Or just get close to the target? And someone like ARK Invest has a price target of $4,000 on Tesla in 2025, right? And if we take 50% compound annual growth rate from last year's deliveries, as Tesla has said they will be able to do for some years to come, we will have 4.7 million cars in 2025, and we know they earn about $50,000 per car and have an operating margin of 19.2 in Q1 here, so let's round that up to 20 to keep it simple, and they have 1 billion outstanding shares. Well, that will give Tesla an earnings per share of 47. So if we take ARK Invest $4,000 and divide it with the 47 EPS, we get a PE ratio of 85. So 85 would be a very high earnings to share for a car company, yes, but not unrealistic for a growth stock. Remember, Amazon had hundreds of dollars in PE ratio. So you can play around at home with the EPS and the PE you think it should have and the earnings that Tesla will make just from a car business, as I just did here. But if Tesla makes 20 million cars with $50,000 per car and an operating margin of 20%, we are talking about earnings per share of 200. But if we take something a little closer because it's easier to guess and it doesn't get too crazy, well, Elon is still aiming for 1.5 million this year. And if we take the numbers we have today, $50,000 per car, operating margin of around 20%, and divided by the outstanding shares, we are looking at an earnings per share of maybe around 75. And if we take a PE of a software company like 20 PE and not the 90 PE that Tesla have trailing 12 months, well, we end up with $1,500 in the stock price. And today is about 750. So just as a car company, just this year, I think it's bound to go up. But what if the PE doesn't drop to 20 because people are willing to pay multiple earnings because they think the earning will go up like crazy? Well, if it stays at a PE of 30, well, we are looking at a stock price of $2,250. So you can play around with these numbers as you like, but we of course will never know for sure. But no matter how I look at it, Tesla's stock price is bound to go up, especially when we take into calculation that Tesla is not just a car company. This was just looking at Tesla as a car company, but Tesla has huge potential in many other areas than just their car business, and this is why Tesla doesn't fit into a little box called car company. Tesla is a tech company with huge growth potential. Tesla is a software company with huge growth potential. Tesla is a robotic company. Tesla is an insurance company, a battery company, an energy company, and Tesla is also a car company, and all with huge growth potential. So we need to add some of the value of all these other sides of Tesla's business to even try to comprehend where Tesla stock might be heading, and that is why, in my opinion, Tesla should have a high PE ratio, because the potential growth is just nuts. So if Tesla sells about 5 million cars mid-decade, doesn't matter if it's 25 or 26, but when Tesla gets to it, it will probably have an EPS of 50. And if we should hit the PE ratio of today with 90 trailing 12 month, well, we're looking at $4,500 in the stock price. So very close to ARK Invest prediction. And ARK Invest is only looking at disruptive companies, so they do understand these kind of companies and why they get Tesla and why they have been right so far and earned billions of dollars in Tesla, and why the short sellers has lost $billions. And speaking of the short sellers, what about the arguments from the short sellers? Well, let's take a quick look at that before we end off. So, there is a demand problem. Demand for EVs right now is pretty much endless for many years to come, for every EV maker, not just Tesla, but including Tesla. The competition is coming. Well, great. The more, the merrier. It helps Tesla's mission. It will not stop Tesla's growth though, just as we have already seen it didn't. So not even an argument anymore. Tesla lives on EV credit. No. Still old news. It helped Tesla in 2022 become profitable for the whole year, but in 2021, Tesla had a net income of $5.5 billion, and EV credits was only $1.4 billion. So even without them, Tesla would still have made a net income of $4 billion. So that no longer matters. It is only salt in the wounds of the legacy automakers that have to give Tesla free money. Tesla doesn't need them anymore. Tesla's market share is decreasing. Of course it is. As more comes into the market, Tesla's market share will fall. That is just math. It doesn't change that Tesla is growing and growing faster, and growth is all we are after. Tesla had a market share of 80%, but that was when the EV market share was 1%. So I will be very, very happy if Tesla's market share falls and drops all the way down to 20% when the EV market share is 100%, because that would mean that Tesla will sell about 13 million cars. But in my opinion, it will probably sit more on 25% of the market. But no matter what, Tesla's market share is shrinking, but the market is growing, and so is Tesla. So this is just the dumbest argument you can ever hear. It's simply just stupid. But Tesla's build quality sucks, so no one will buy them. You probably hear this from a friend of a friend or somebody you meet. Well, the car expert of car experts, Sandy Monroe, that measure panel gaps and all that kind of crap, says Tesla's build quality today, not a year ago, not 2 years ago, but today, is as good as anything coming out of Europe, who is known for its good build quality. So not an issue anymore, just lag time of the mainstream media and public opinion that needs to catch up to reality. So not going to be an issue. Tesla's build quality is just fine. So to try to sum this up, Tesla as a company is growing faster than anything we have seen before in the history of large manufacturers. And even just as a car company, I think they are bound to hit multiple $1,000 in share price, because Tesla is showing higher operating margins than we have ever seen in the car industry before. Tesla will start printing money. The trend is as clear as day. Tesla is only going up and faster, and growth and earnings, well, that is what we're after in the stock market, right? And someone like GM is only going down. I'm not shorting them. I don't short companies. I hope they survive. I just bet on the ones that I see the most growth potential in. And when it comes to Tesla, I don't think we have ever seen anything like Tesla before. They are a whole new breed of a multi-company. And because they have entered the AI and robotics game, I think the valuation of Tesla has a long way to go. They could keep growing for decades, maybe more. So, hope this video could calm you down if you are Tesla investors and are panicking because the stock is down. Or maybe help you if you are arguing with people that think Tesla's valuation is too high. Well, show them this video and get the discussion going. And thank you for watching. And until next time, take care out there and be nice.